Hey, everybody, what do you say? What do you know? Tom is here, and this is my Power Profit Strategies podcast for Friday, February 2nd, 2024. I call it I'm recording it on Wednesday. You'll get it on Friday. You'll probably hear it on the weekend podcast. So I'm taping early this week. I got a special project going on the other side of the state that I got to get to tomorrow. And I want to talk about, why you don't want to trade the news. Okay. Because I'm sitting here watching Jerome Powell, or I finished watching him, and I was watching what the markets were doing as he was talking. And I thought, what a good time to be talking about what you don't want to be doing. All right. So we're going to talk about why you don't want to trade the news and you want to trade patterns instead. I've got two patterns I want to talk about here in the podcast. And you don't need to see me for these patterns. You just need to listen. Also, I want to finish up on something called taking responsibility. It's something my kids had a little issue with my kids this week, and I thought, man, this segue is really good into what I want to talk about in the podcast. So, like I said, it's Wednesday. The markets are closing up here real soon. Everything's in the red. Looks like those YouTube sensations, you know, those ones. They used to be, last year they were construction workers or delivery drivers, or maybe before COVID, they had a job where they were punching in, and then the COVID got them to stay home from work, and they got stimulus checks. Thank you, Joe Biden. And, it's his fault that we've got all these people that have decided to become YouTube sensations, and many of them have all of a sudden become market experts. So, that guy that used to deliver pizza, now he's a market expert. My goodness. It looks like they're going to be squawking. They're going to be squawking about today. They're going to say the market crash is coming and they were right. You know what? You know why there's so many people out there talking about a market crash? Because that's where the clickbait is. The clickbait is not in the markets are going higher. The clickbait is not in rules-based trading. It's not in the unemotional stuff. Clickbait is emotional. Now watch what happens. We might get a pullback. All right. We might get a pullback. We should get a pullback, actually, after what's happened in November and December and even most of January. Yeah, we should get a pullback. But I don't remember the last time the market was crashing with an economy like we have and with rate cuts coming. I mean, we're almost in that Goldilocks era. I like to think that the last time that we were in this kind of situation, and I'm not talking about the national debt, okay? That's huge. But go back to the Clinton era. Remember those times? Remember those times in mid-90s? Everybody's worried about Monica Lewinsky. and you know what we weren't worried about? We weren't worried about the stock market because it was moving steadily higher in a low interest rate and bustling economy environment. So, one thing I do know, I don't trust a guy on YouTube that was a real estate expert last year and all of a sudden decided to be a stock market guru this year because he can make more money on click-throughs. Although many people are just going to, trust these people anyway. So, I mean, what am I going to do? So anyway, I'm getting this done early because I got to head to the other side of Florida. I got a special investigative project going on. And no, before any of you decide that you already know what I'm doing, it's not the Daytona 500. Oh, that's a good idea. I asked my wife to come along. They're going to be gone for a couple of days. In fact, I'm really jumping out Thursday and jumping back on Friday. But I want her to come. Maybe we could hit Disney on the way back. And I was thinking last time we went to Disney, late last year for the International Food Festival. Any of you done that before? I remember going to the International Food Festival. It's like on Sunday. I like to sleep in on the weekends. I don't get a chance to do that. And, and my wife says, hey, you want to go to the International Food Festival? Get up early. And I'm thinking, no, But I can't say that. I mean, maybe I say this. You know what? Great idea. I mean, why wouldn't I want to wake up on a Sunday when I don't have to get up, drive 2 hours to Disney, then spend, then I got to park, I got to pay to park, and I got to spend hundreds of dollars to get into the park to spend more money on food. Now you're thinking. No, I didn't say that because that's not how it happened. I mean, we have annual passes. So I'm just looking to get the most out of these passes because that's, when you invested something, and I look at it as an investment. I want to get the best return out of my investment. Just like you want to get the best return out of your investment, maybe listening to me. So I'm going to get past this quick. And so here's the thing, these passes, they were $1,000 a piece. We've only used them once since November. I need to use them like 3 times if I want to get the benefit out of them. So I'm going to get her out there eventually. Let's talk news and why I don't listen to it. Okay. So before I get into the news and into actual news itself, we need a little direction here. We need a definition of what is news and what is not news. So let's talk about what news isn't. Okay. CNN. I don't look for my news from CNN, MSNBC, Fox, One America. These are all 90+% opinion channels and 10% news. Okay. I mean, there's your local channels. Thank God you can get news off of these folks. They're 90-10. They're 90% news, 10% opinion. But I'm talking about financial news. I'm talking about, let's talk CNBC. All right. It's a 24-hour channel. Now we know when the markets are closed, all right? What are they doing? Shark Tank and some other stuff. Okay, that's not news. They're filling time. But let's get into the 9 to 4 segment. Monday through Friday, 9 to 4, CNBC. News or not news? I'm going to say not news. And here's why. I went and Googled the programming schedule for CNBC because I don't watch CNBC. So, I mean, I have it on every once in a while, but I don't watch CNBC from morning until afternoon. So I don't know what they got going on, what they call these things each day. So I had to go out and Google it. Squawk on the street. All right, they got that. You know what that is? That's squawk. Squawk on the street. Heard it on the street. Heard it on the street from who? People. People, opinions. Right? Next up is money movers. This is someone just telling you what's moving around. Again, I don't need anybody to tell me what's moving around. I can figure it out on my own. Then there's fast money halftime. Okay. That's what's moved around in the last 2.5 hours because all of a sudden now we're at noon. Then in the afternoon, you have the exchange. That's just a different name for the same stuff. And closing bell, where are things at now? So if you look inside these programs, this is what you're going to get with every single one of them. You have a ton, and I mean a ton, of people that they're interviewing, and they want to know where they think things are going. And these people will tell you where they think things are going, and they might even have some good arguments about why they think things are going there. But here's the thing. This is the catcher, and I find this in almost every occasion. So, what's happened recently that didn't happen years ago is that CNBC and financial channels had to put up a disclaimer that showed what that analyst had, whether they traded the stock that they were investing in, and whether they owned it, whether the family owned it, whether the brother-in-law owned it, whether the girl across the street that they were peeking on in the middle of the night owned it. And so most of the time you just saw no. They don't know any of this, yet they're talking about it like they do. Okay. So like I said, mostly opinion and analyst talk, buy, sell, or hold. Every once in a while, they got something newsworthy. I happen to punch in when there was newsworthy stuff going on today. Remember, this is a Friday podcast, but I'm doing this today, Wednesday. And guess who was on Wednesday afternoon? Chairman Powell. And he's speaking. And, all eyes are on him. This is actually news. He's not giving us any opinion. So all of a sudden, there was a break from the opinion as Chairman Powell started speaking. And I'm going to sum everything up for you with what he said. No rate cuts yet was basically the gist of what he was saying. Now, before he started speaking, all the averages were down. Okay. So what happened when he started speaking just after 2 o'clock? So from 2 to 4 o'clock, I'm going to tell you what happened. Okay. I'm going to tell you exactly what happened. If you take a look at and let's just take an index. So what did the index do from 2 to 4 o'clock? Well, guess what happened? At 2 o'clock, we were around 486 on SPY. We spiked to 489. What does that mean? That was a 3-point move up, which is 30 points on the S&P, which is 300 points on the Dow. You know what happened after that? It crashed. It crashed down. The SPY went from 489 down to 484. So that was 5 points down, 50 points down on the S&P, 500 points down on the Dow, and then we consolidated pretty much toward the lows of the session. So we went hard up, hard down, consolidation. That happened with SPY. That happened with the Qs. That happened with the Dow. And where did everything end up at the end of the day? I mean, they're lower than they were, but I mean, the NASDAQ is down 2% because, we're kind of cooling our jets now on some of the tech stuff. All right. So if I sat there and watched Powell with one eye and I watched my brokerage firm with another, I saw my brokerage account. It went up. It was pretty much even for the day, even though the markets were down. Then it went up. It was actually looking pretty good. Then it came down. Now I'm slightly lower for the day. And I'm talking about stuff where I actually own. I own long-term stocks. I have some option trades in there too. But this is where I own where I have a lot of my long-term stuff. If I look at my, some of my option stuff, some of my option stuff was down a little bit today too. But when I look at where it was versus because I judge myself to the benchmarks, and that's the way you should too. But at the end of the day, here's the question. It's not about me or my accounts and what they're doing all day, every day. I don't look at these things every day. And, I don't suggest you do either. Again, and it's because even news, okay, the actual news is, even trading the actual news to me in my mind is bad because just look at the last 2 hours of Wednesday when Powell says rates aren't going to be cut yet. All of a sudden, spike up, spike down, and then we went sideways. Who makes money like that? I mean, not me. Day trading, they say day trading is a skill. It's not a skill I care to do. Okay? Roofing is a skill, but I'm never going to see myself up there with the roofing hammer, especially now. I mean, these are just some things I don't care to do. I think some of the best patterns aren't found in 30-minute blocks. I think they're found in 30-day blocks. That's a skill that I like. So let's talk February. So you look at February. Two things that I see happening in February right off the bat. I mean, I can say it. You don't have to see it. Number one, if you take the February calendar, tear it in half. The first 2 weeks, we have both mainly moves to the upside, okay? The last half of the calendar looks like we're heading down. It's interesting because after the first 2 weeks of February, we're done with earnings season for the most part. So what's going up in February? I see healthcare moving higher. And it's not because I think it's moving higher. Here, let me give you a pattern right now for those of you that have hung on for the last 10 or 15 minutes on the podcast and you want something of substance. I like to think all my stuff is of substance, but you know what? That's my opinion. Anthem, ANTM, ANTM. Okay. I'm looking at bullish patterns from February, from the beginning of February to the middle of March on this one. And it's not what the overall markets are doing. It's what Anthem has done for the last 10 years. 9 of the last 10 years, Anthem has moved up between now and March 12th. Okay? You want more information? Okay, I'll give you more information. This thing's gone up. It's got a net profit of 100, and there's that bell, $114 over the last 10 years. That's about $11.40 per year on average. It's a 29 trading days, 90% accuracy. That means the last 10 years. This thing has moved up between now and March 12th. So, all right. There's something else I like to look at too. I go into each year and I see how did it move? How did it move? You know, the average is $11.40. That's a nice little chunk there, right? For the stock, even better if you're an option trader and you know what you're doing. But I also look at run up and drawdown. So during the last 10 years, how good did Anthem go in our favor? And then how bad did it go against us? Max profit was $47 up in 1 year. Max drawdown, and this is anywhere in the pattern, not beginning to end. What's the worst that this thing moved against us anywhere in the pattern in the last 10 years? Well, 1 year it moved against us by $22.81. It didn't close that low, but that's where it was, somewhere between the beginning of February and the middle of March. All right. But everything is there. All right. So what's your takeaway? Your takeaway is don't take my word for it. Go out and check it for yourself. Go look at ANTM and look at what it did around the beginning of February to the middle of March for the last 10 years and see what I see. And then if you like it, then do a little more homework and say, well, what would I get if I bought the stock and I shot for an $11.41 move? And then the next thing you're going to do is you're going to say, well, what if I bought call options? What could I stand to make then? What if I bought a call spread? What could I stand to make then? This is where you migrate. What we did, guys, what we just did was we didn't listen to Powell. We didn't listen to the YouTube guys, you know, the guy that was putting windows in last year. And now all of a sudden, instead of seeing his reflection in windows, he's now offering up his reflection in where he thinks the stock is likely to go. We're not doing that. We are pattern-based traders. We're spotting patterns, and then we're migrating into creating an investment or a trade based on what we see in the patterns. Okay? There you go. And then it's just a matter of, on Monday, plan, execute, manage. That's it. Now, I said I was going to have two patterns for you. All right, second pattern is in oil. So here's what's going to happen. I want you, this is for you guys that are out there. All right, ladies, you listen up too. It's for the guys. I want you to do two things. I want you to do two things in February, right? Middle of February, you got to do, you know what the first thing you got to do is? You got to get your spouse or your significant other a Valentine's Day gift. Okay, this is how I'm going to ingrain this in your brain because you're going to forget about it. Actually, if you keep listening to podcasts, you won't forget about it. But let's say you forget, you don't listen to podcasts anymore. You're going to remember this. You're going to say, oh, it's Valentine's Day. And you may forget it's Valentine's Day until it's Valentine's Day. But you're going to remember it's Valentine's Day. And then you're going to remember something that Tom said. And that is what to do after Valentine's Day. So step one, get a Valentine's Day gift for your spouse. Step two, look at buying, look at going long into oil and oil stocks because there is a pattern, a 5-month pattern that begins in mid-February and runs until mid-July. I call it the Valentine's Day to Independence Day trade. Okay? So oil stocks. What am I looking at right now? I got 3 of them. And I haven't done anything yet. I'm waiting until the pattern begins. But USO is one of the ones I'm looking at right there. That's United States Oil. That's the United States Oil ETF. All right. Currently, that sucker's trading around 70. It's around 70 to 72 right now. Okay. The low for the last 6 months has been 64, and the high's been close to 84. So we're sitting kind of right in the Goldilocks spot between the low and high over the last 6 months. Okay. USO trades very, very highly correlated to the price of oil. So that's the most correlated one out there. The next is a company, and it is Halliburton. All right. So I'm looking at Halliburton. Halliburton trades pretty close. I'd say it trades about 75% to oil. And so that means that 75% of the time, when oil is up, Halliburton's up. When oil's down, Halliburton's down. Halliburton is right now trading in the 30s. Think about $35, $36 a share. So that's another one you could look at. And then the third, and I'll bet you could guess this one if you really thought hard, ExxonMobil, symbol XOM. All right, did I give out Halliburton symbol? I did not, HAL. So HAL and XOM. XOM's the third. That stock's trading for around $103 a share. So all of these are based on a 5-month pattern. Go back and, 5-month pattern. Begins in the middle of February, ends in the middle of July. Go back and look at the last 10, 15, 20 years of oil and oil stocks and see what they did. I believe that pattern is correct about 75% of the time. Okay. So there you go. So there's some food for thought. Oh, by the way, I'll have it next week, but the details on the oil and energy pattern, I will have a link in both videos and podcasts, upcoming podcasts, to a special report that you can get, right, by yours truly, that details all of this out. All right, so let's talk about the final few minutes of the podcast, and I'm finishing up early today. Is responsibility. When I talk to my kids, I talk to them, and I'm not talking about that talk you have with the kids, the talk, and I'm not talking about the sex talk or the drinking talk, drinking responsibly. You know what I'm talking about to my kids now? They're all in their 20s, and one's turning 30 this year. So the 30-year-old, I'm saying, hey, your 20s are over. You got to start thinking a little farther out than 2 weeks, because most kids are, they have paycheck mentality. My next paycheck's coming. I got bills to pay, and then whatever's left over, I'm going to spend it. That's most kids. So I got one like that. And so, people think, oh, wow, would it be great to be Tom's kid because he gets everything. No, he doesn't. None of them do. Most are very responsible. But I got one who's, he's starting to see it, though. The Teflon's coming off. When you're a kid, you think you can do no wrong. You're never going to age. You never have problems. And then when 30 hits, that's a milestone. And you start thinking, where am I going with my life? And so he's starting to realize that he's got to start thinking about his future. He's got to be responsible for his actions, for his money actions. And I want to ask you this question, and not for money or anything else, but for trading. Can you take responsibility for your actions? And this breaks down into two pieces. Number one, education. Okay. I mean, when I used to do live events, and that was years ago, I don't think I've done a live event since 2019. Yeah. But when I did live events, I used to look at the crowd, and there were those that took notes and there were those that didn't. And, sometimes I used to think, well, the guy isn't taking notes. He's listening to me. He sees me. But then I used to give credit to the note takers, because you know why? This is me too. And when I write it down, I'm committing it more to memory. And so, do you take notes? When you listen to a webcast, are you taking notes? Do you ask questions? I'm amazed by the amount of novice traders out there who will stick good money into something and they have no understanding of what they're doing. I mean, let me give you an example. Okay, so Google reported earnings earlier this week. And of course, I'm listening to all the talking heads on TV. And these are the ones, I'm not talking about these, YouTube sensations. I'm talking about, I saw a guy on Bloomberg, and he says, Google, he made a good case. He goes, of all the Mag 7 stocks, Google has the most value. All right. Basically, he took the PE ratio and came up with that brilliant idea. It had the most value. And so it's in search, and nobody else does, is anywhere near search, and they're going to be great. And everyone's going to realize that Google is up. And so his indication was buy Google before the earnings come out. All right. So, I mean, I hate to break it to you, but if you bought Google before the earnings came out, you're down 10%. You're down 10% from from before the earnings to after the earnings. And why? Why is that? Well, they had better earnings. They had a 164 actual on a 160 earning, but you know what's killing these guys all now? It's forward guidance. Forward guidance. But that's not where I'm going with this. Again, I jumped off the train tracks. Let's say you are bullish on Google now that it's come down, and you decide you're going to buy a call spread because you heard call spreads are cheaper. They move around less with the stock price, and they got a better break even. And in a lot of cases, you can get a better return on investment than just buying the calls. All right, and that's what you heard. What you need to understand about call spreads is not just that. You need to understand what the price movement or the delta is and what Google can do to the spread. You need to understand what the other option Greeks do as well. You got to understand what's going to happen if you hang on to the spread during the entire life cycle of that expiration. All right. You need to understand when expiration happens, and if the price of Google is below your strikes, what's going to happen. If it's above your strikes, what's going to happen. And most importantly, if it's between the strikes at expiration, what's going to happen? Because if you don't know what's going to happen and this thing expires between the strikes, oh, you're definitely going to know something's wrong the following Monday when you wake up and you look at your brokerage account. All right. So take responsibility for your education. I don't jump into a pool until I take the temperature. And I don't get into something unless I thoroughly understand it. That's one of two. The second is taking responsibility for your actions. Here's another one. I love this. Okay. This is something most people miss the mark on, a lot of the novice people. You know, I remember watching TV and I watched this guy just scream and yell about getting into something. I never saw more emotion. And I remember because it was 1987. It was an emotional year. And I took a position based on this guy screaming his bloody head off. And I remember cussing out the TV and him after that because I got a margin call back in 1987 based on what I did. In reality, you know what I was doing? I was trying to push the blame to somebody else instead of saying to myself, self, it's your fault, because whether this guy knew what he was talking about or not, you still took the trade. You simply took the lazy approach. You didn't do your own homework, and you need to be responsible. You need to take accountability for what you did. Okay? So regardless of where you get your information, you and you alone are the one that enter and exit the trades. Okay? That's it. I'm getting off the soapbox. Again, guys, end of January is here. We're going into February. It's a mixed month. It's going to be, kind of in like a lamb and out like a lion, I guess we're going to call it that. The seasonality still says we're going to have a little bit of a slow burn to the upside, but then things get very questionable after Valentine's Day. Let me tell you something. If you don't go out there and get your spouse a Valentine's gift, things might be pretty questionable for you. So there's my 2 cents, 1 cent of information, guys. Take it however you like. That's the podcast for today. Feel free to leave comments. I'll see you on the next one. Bye now.